Hello, everybody. Welcome back to the Anomaly course, Core Content Lesson 2. In this section, we're going to be covering key level filtering. In the first key level we're going to be talking about is how to filter out highs and lows. But firstly, you must define what is a relevant swing. It is really simple. It is simply spaced out highs and lows. We're looking at the proximity. I would say a fairly easy way to mechanically define a relevant swing is by using the premium discount tool. Now, I don't have a slide going over this, but it's simple, right? Mark out from low to high. 50% will be around here. Any low printed at EQ or in premium is definitely a defined relevant swing. If it's in deep discount, I really wouldn't define that as a relevant swing. But relevant swings are essentially the highs and lows that we want to be using for our key levels. So now let's talk about what a failure swing is. It is the exact opposite of a relevant swing. It is not spaced out highs and lows, right? So you can see the space between that, right? If you mark out premium discount from here to here, this is in premium, right? It has that large proximity that we want. Over here, we have that close proximity, right? From low to low. So this low here, we're not viewing this as a relevant key level. So if price comes down here and tags this low, we don't care about it. We care about the relevant swing being tagged, all right? So as you can see, if you mark out from low to high, this low is printed in deep discount. So when price engaged with a failure swing, we do not look for reversal. We only look for reversals at relevant swings. We'd actually rather target failure swings as a draw on liquidity. So now let's go ahead and cover what a protected swing is. And that is simply when price engages with a relevant swing and manipulates it, right? Once price engaged with the relevant swing, manipulates it, expands away, essentially you have high resistance liquidity being created, and there's no reason to return to this level because the proximity to the next relevant area is far away, right? Price has cleared out all liquidity in this given area. Therefore, there's no reason to return. So as you can see, this failure swing here, just sitting above this relevant swing, we only care about the relevant swing being engaged. So in this little slide here, it's going to be talking about when to use 15-minute gaps versus 1 hour / 30-minute gaps. It's really, really simple. So when you have a higher time of draw liquidity and that reversal, you're going to have internal objectives on your way to the overall draw liquidity, right? So you see this relevant high here, the space between these highs, right? That would be a relevant high. When we engage with these relevant levels on the aligned timeframes, the lower timeframes, this is where we can get new phases of price, right? So very early on in that reversal, you're going to be within, an hourly C2, C3, C4. This is typically where you're going to find 15-minute gaps. It's actually within the creation of these hourly swing points, right? But once we engage with these hourly relevant levels to the left on our way to our overall draw, as time passes, it's going to create, candle 5, candle 6 on the hourly time frame, etc. This is when you can get an hourly gap, right? Or an hourly new phase of price after we hit an hourly key level. So really, this is a mechanical way to decipher where to use the 15-minute gap. It's going to be low in the range early on the reversal, higher in the range after hitting relevant levels. This is where we're going to get new phase of price in the 30 minutes, that's the hourly. So that's when I choose those higher time frame gaps. So another way to look at it is like this. Here's your higher time frame universal model, right? Mark it out from higher time frame draw liquidity to higher time frame reversal. And below EQ, you can use 15-minute gaps. And above EQ and premium, we're going to use those higher time frame gaps. So now we're going to talk about how to filter your entries. So with this little example here, what is the problem here? It looks all good, right? C2 candle, C3 expansion, right? You have the candle opening low first. You have an order block that looks good to enter, right? But there is a problem here with what exists inside of this C2 candle on the 15-minute time frame. Let's go to the next slide and check it out. So when we look within this previous C2 candle, what do we see? Price has a 15-minute fair value gap within it. So if you are entering before we tag this 15-minute gap on the lower time frame, you're essentially putting your stop loss right above a higher time frame gap, right? Which is obviously not a protected level. So the way this usually forms, where we have a C2 candle and a 15-minute gap within it, is when we create a reversal into expansion candle, right? With these big expansion candles on the hourly time frame, whether it's a C3 expansion, C4 expansion, or a C2 reversal into expansion candle, they can create these 15-minute gaps. So you want to look within these candles to make sure there's no gap within it. That's basically what you need to wait for, right? If there's a gap, you need to wait for it to get hit and then price to reverse, because that would be a protected lower time frame entry. If you're just putting your stop loss right above a 15-minute gap high, that's not a protected level, right? For the lower time frame, wait for that lower time frame to hit that key level, and that will be protected, right? So here is putting that all together, and this is essentially the same thing, but the 15-minute gap is forming when C3 opens, right? So basically, when we open this candle, right? When we open this candle, is there a gap technically? No, but there's a future gap going to be created. We know that because when this 15-minute candle closes, right? Look at these wicks. They're not meeting. They're not meeting together, which means there's going to be a future gap there, right? So we got to be careful for existing 15-minute gaps when looking for entries in these swing formations and future 15-minute gaps, right? So look what happens here, right? You see this wick right here? Price opens low first to create the wick of C3. You think this is a protected level, right? So maybe you enter there or whatever, but you're gonna get swept out. Why? Because when this 15-minute candle closes, that low is the 15-minute gap high. So you're putting your stop loss on a future 15-minute gap when this candle closes, right? That's not a protected level. Wait for it to close, and then we wait for price to tag this gap here. You get your CSD to confirm that gap there, and that is the low of C3. That's a protected lower time frame entry. And sometimes it's going to leave the gap open. So what, right? We're trying to go over the highest probable lower time frame entries, and that is where there is no reason to return lower, right? If we tag this gap here, there's no reason to return lower. If you start entering, above gaps and stuff, there's a reason for price to retrace and take you out of your position, which we don't want. Now let's talk about the creation of future higher time frame gaps. It's essentially what I just showed you in the last slide. So let's go over it here. So looking at the 15-minute chart here, you might think this is a valid 15-minute gap. You have your SMT fill, your confirmation. Maybe you have a lower time frame CSD to confirm this. While it's printing, price might look like this, right? You see this? Price might look like this, but again, when this kind of closes, what is it going to create? A future gap. So again, you're basically putting your stop loss on a future gap high, which is, again, not a protected level. So we want to avoid this, right? Wait for the higher time frame gap to be created. So you have to wait for this candle to close. Once it gets tagged is when you can then look for an entry. So now let's talk about key level alignments. So this is essentially aligning a higher time frame model with an aligned model, or a model within a model. So what does that look like? We have a higher time frame universal model, right? Reversing off of range low. We're going to target that range high, right? But once price reverses at the range low on the lower time frames, or the aligned time frames, price will displace away. That displacement away will create a gap. So what do you have here? A key level and the draw liquidity. A IRL to ERL on our way to our higher time frame draw liquidity. So now you're aligning draws and liquidity and key levels, right? You're going to use this key level to get to our draw liquidity, right? Once you have this alignment, this model inside of a model, there is nothing more high probable than this specific scenario. So as you can see, price expands away from the IRL, leads failure swing. So we know this is probably a retracement lower, right? Or a consolidation. Once price engages with this low, which is a relevant swing, look at the space between these lows. This can be our aligned range low to get to our overall draw on liquidity, aligning multiple models in the same direction. Now let's go over a chart example for relevant swings. So here we are on the daily. We always want to start off with the higher time frame universal model. And as you can see, we're going to be using manipulation ranges, which the key level is going to be swing low. And of course, how do we filter out swing highs and lows? Is we want relevant swing highs and lows, right? So as you can see here, The space between these lows is what qualifies this as a valid swing low to use as a key level. And we get that C2 candle confirmation. We have the SMT. Every time we engage with a relevant swing high or low, or any key level in general, we want to have SMT, and ideally two-stage SMT, which is actually what we have here. So as you can see here, you have an SMT with our key level, and you have an SMT with the swing, which is kind of like that roof SMT, right? This is what we like to see, and it's also a strength switch. So if you go over here to NQ, you're going to see that here. As you see, it's showing relative strength, and then short term, it's showing relative weakness with that two-stage SMT. And now let's talk about how to use relevant swings within the universal model. So on the left side of the curve, going from point A, reversal, to point B, drawn liquidity, inside of this range, you're going to have relevant levels on the lower time frame. Now, in this case, you can see we have a relevant level on the daily chart. Actually, you can see this internal high here. This is not the important high necessarily, right? It's actually this one. These highs I would deem to be not relevant. This is not a relevant high in my opinion. It's kind of hard to make it fully mechanical, right? I did give you guys this example where we could use like the premium discount tool, but it's not always the case, right? You kind of have to eyeball it. Really, you're gonna get a feel for it. But premium discount, for example, like ideally, this low is ideally, an EQ or like premium. That's like really easy to make it mechanical, but this is fine as well. But if it was like, down here or something, obviously that would not be a relevant swing. These lows would be too close, but this is okay, right? We also have the confirmation to it regardless. This is why we use two-stage SMT to filter out key levels as well. But let's go over to the lower time frame and let me show you guys how to use relevant swings on the left side of the curve and the right side of the curve. So dropping down to the lower time frame, you're going to have these internal targets to the left, right? Where we're not expecting price to reverse from. We ideally want to see when price engaged with them, price to fail to manipulate. That's exactly what we want to see. And once price engaged with these levels, they're typically going to be found in the hourly, the 30-minute, the 4-hour. We're waiting for a new phase of price, right? We're waiting for retracements, consolidations. We're waiting for those key levels to get hit to then expand again, right? So when you look inside of this here, right, this is very, very, very clean. We're going to remove this SMT and we're going to pretend it's not here, right? So I want to show you guys something here. So when we look to the left, every single high internal, we want to see price fail to manipulate. So this is the most recent high right here. After we create the SMT, I can see price is not manipulated. This is the first sign that your universal model is actually going to play out, right? We're actually going to continue. But this is one of the best things you can actually see is when price creates an SMT and then it reverses, it expands, right? But it falls short of an internal level or the overall drawn liquidity and then starts to retrace. That's going to create a failure swing, if it retraces deep into those levels. It creates a failure swing. So essentially what we have at the point of retracement is a failure swing, which is not a protected level. And on the opposing side of that, you have a protected swing, right? A manipulated relevant low. So this range that you see here is actually very, very high probability in price, right? And every single low, every single relevant low that we put in on the right side of the curve, we want to be manipulated to continue higher. So you guys see the space between this low and the overall low over here. All right, this is exactly what we want to see price do, right? We actually have SMT here between RTY as well. I'll show that really quick. So even if we don't have SMT down here, this would also be valid because RTY, as you can see, an SMT right there. So now you have a new universal model. We have a point of reversal. And on your way to these highs to the left, you engineered a new high, right? We're always going to be engineering new highs, whether they're relevant or failure swings that we want to target, right? These are aligning draws and liquidity, which is what we're going to talk about in just a bit. But let's just talk about this universal model, right? Order paying ranges to this low and this high, you have an internal relevant high, right? So now let's go into price action here, and you're going to see exactly the same thing. So when we drop down, what do we have? A manipulation. Kind of price looking a little sloppy, but what does it do when it starts to retrace, right? What does it do? Leaving failure swings here. You should have a failure swing and a relevant swing here. And if you look back from this range, what is the only level to really react off of, right? It's this relevant low. Look at the space between this low and this low. So now if we're going to continue, this is where we need to reverse from, right? And you're going to see here that triad sequence for SMT break, right? Look at this. It's beautiful. Right when ES breaks this level, price reverses, and NQ over here has an SMT there. Perfect, right? And we're using that triad sequence with an actual relevant low, not just any low ever, you know. It has to be a relevant level, right? As you can see, price, when we engage with this high here, this relevant swing, we want to see price do what? Fail to reverse, right? You can see it's just trading right through it. That's perfect. So now we know that this range should be holding. You have a protected swing as the low of the range. And look what price does. This point of retracement, it doesn't trade into anything relevant. What is it creating? Failure swings again. This is exactly what we want to see, right? Is this right here. So as soon as we start to fall back in the range, you're looking for either a relevant swing internal to this range, you're looking for the most recent gap in price, or you're looking for a relevant low to be actually printed. So that's what we do. We actually print a relevant low in the retracements, as you can see, the space between these lows. And this is where you want to see manipulation. Now, price doesn't manipulate this low. There's no SMT, so you can't trade this expansion. It's as simple as that. So now jumping back to the 4-hour time frame, as you can see, we finally get to this higher time frame, you know, that daily failure swing. And this is where you want to see what? Price failed to manipulate. That's exactly what it does. It consolidates here. We want to see those continuation signatures, you know, retracements, consolidations. It consolidates. That's a continuation signature, which we know when we have that, we are going to continue through it towards our overall drawn liquidity, which is exactly what price does. Now let's go ahead and talk about gap filtering. So we're always going to be applying these concepts to universal models. So let's go ahead and use this example, right? We engage with this relevant low, space between these lows makes it relevant, right? We want to have our confirmations. We have SMT. We have a C2 candle. So when you have this C2 candle, as soon as this prints, you're going to look at the 30-minute and the 50-minute to see if there is going to be a future gap, right? Do you see any gaps in price that can be created on the 50-minute? No. What about 30-minute? No. So you're immediately good to go to entry, just right off rip, right? And as you can see, we have a nice V shape for sure. We have our gap here. We have a potential CSD. So as soon as this gets created, you're pretty much good for entry, man. So boom, you can enter here, per stop loss at the low, or here, wherever you guys choose. We could target our overall universal model high, and this would be a valid entry, right? But I'm going to show you an example where this would not be valid. So if you play price forward a little bit, price kind of chops around for a bit for sure. But when it reaches this high here, these internal relevant swings to our overall drawn liquidity, you're always going to have those internal levels. This is where we're going to wait for a new phase of price, right? So you can see here, we kind of just retrace really deep back into the range. We're not so concerned with this being a win or a loss. You know, this trade here, I don't care. That's not the point of this video anyways. I'm not here to show you the most perfect entry ever. Really what I'm concerned about here is showing you guys when to wait for gaps and when it's valid to enter. So let's just use this C2 candle as a example. Now there's no key level here, so I wouldn't really trade it necessarily, but there is actually there's an SMT here on the lower time frame, so it could be fine. Using that logic, you have a relevant swing here, you have SMT break, which is what I went over in relevant swings. You watched this before, so it could actually be fine. But if you're looking at hourly, technically no key level, but this would be the actual valid entry. But anyways, we have a C2 candle, right? We have that closure. So again, let's go to 30-minute. Are we going to create a future gap here? No. What about 50-minute? No. Boom. You can enter this trade. Your lower time frame, your stop loss will not be on a higher time frame gap. You're going to see exactly what I'm talking about in a couple minutes. But this would be a valid entry. Look at that V shape, continuation CST. There is nothing wrong with this trade, man. That would be good. Now, here, you are not going to be entering within this C3 right here. You're not going to be entering this right here. Now, why is that? You might think it's a nice continuation, right, or whatever. For one, the RR, right, to this relevant high is really low. You ideally want QR to these relevant levels. That's not really the point, though. The point here is you're putting your stop loss on a gap low, right? Look at this gap low here on the 15-minute, on the 30 minutes, which is actually right here, right? Do you see that when this candle closes, it's going to create a future gap? So you're putting your stop loss basically at that gap. That's not a protected level. So when you engage with these levels, especially, is you're going to get those new fits of price, those retracements on the 30-minute and whatnot. And at this point, you're going to be waiting for the 30-minute/hourly to create that gap because we just engage with that relevant internal level to your universal model, right? So if we play price forward here, we get that hourly gap, right? This is exactly what we want to use, right? And you wouldn't be entering this either. You wouldn't be into this 30-minute, gap. Why? Because in an hour, when this candle closes in an hour, you're going to create a future hourly gap, right? So as soon as this candle 4, a lot of people think you're going to trade a candle 4 here because you have a valid C3 closure, right? Candle 1, candle 2, candle 3. You can't trade candle 4 here, right? If it just does this and respects EQ, right, it cannot meet these wicks. These wicks cannot meet, meaning that you're putting your stop loss on a future hourly gap. Right, I'll show you. So as you can see, this is the low here. Right, you also just can't enter this 30-minute gap either, because again, the hourly wicks on the higher time would not meet. But as you can see, let's say you entered, right here exactly. This CST, your stop loss is on a 15-minute, your stop loss is on an hourly gap high. Right? That's going to be created in the future. Now, in this case, it works here. Technically, you get a bunch of RR. But that's something you want to be careful of, especially because we didn't even hit the 30-minute gap either, right? So it's really not valid, right? So there's really no entry there. You're just gonna have to just wait patiently until we start to engage with these higher tip gaps, right? And that's gonna give you that nice key level on the higher time frame. Since if we draw out using our premium discount tool from reversal point to draw liquidity, look where we're at. We're in premium, so we're gonna look for the 30-minute and above for gaps, not the 15-minute way up here. You're gonna get destroyed. But as you can see, price now tags this gap here, You're good to go. You have a C2 candle. Now again, you're gonna do the same thing. Are we gonna form a future 30-minute gap? No. 15-minute gap? No. Right? This 15-minute candle is a C3. It's just gonna go like this, right? There's no gaps to be created. So you can go straight to entry here, technically, right? And again, I'm not really too concerned with how it plays out. It does end up playing out here, but that's really my point, right? But now when we engage this higher time frame failure swing on the daily, look at that, on the daily. At this point, a lot of time has passed, right? So you're probably going to create like 4-hour gaps, because again, we're really high in the overall range from daily reversal to daily draw liquidity. So you see how there's a bunch of ranges, and we're all aligning them. But as you can see, play price forward. This is the gap that you want to be using right here. Right? That's the gap filtering that we want to be using inside of the pre-stage range. You can see price consolidates. Once we engage with this, boom, you're pretty much good to go. Now you're going to do the same thing, man. This is a universal model in itself from the 4-hour key level to the 4-hour draw liquidity. Internal to this, what are you going to have? Internal levels, internal draws and liquidity. You guys see that? So you're not going to trade this 4-hour C2, or sorry, you're not going to trade this. So you're not going to trade this hourly C4 because again, look where we're opening. We're opening where these wicks are not going to meet, right? When you open low, unless it does all the way down here, which we don't even want to happen, honestly, because that would just be disrespecting EQ here. We can't trade it, right? This is why C4s are kind of not ideal. C3s are really what you want to trade. C4s, you know, you can get new phases of price and all that, especially after tagging this gap here. You're gonna see there's no entry. You just gotta live with it, man. Price engages this high before we even can create the hourly gap. You just have to live with it, right? We're trying to trade the highest probable trades here, and that's what I'm teaching here. So check this out here. We engage with this low, and let's ask ourselves, can we take a trade? We have a C2 candle. When I look back within the lower time frame, you know, within this candle, are we going to create a gap? No. We're opening a C3 over here. 15-minute? Yes. You guys see that? This is a C4. You see the problem with C4s? Trading C4s, you're going to create that future gap. So it looks valid on the hourly, like, ooh, C3. But when we open low, C3, open low, high, you know, close or whatever, or even before it closes, that wick is going to create that lower term CSD, but that CSD low is a future 15-minute gap. So what we're going to do is wait for this count to close. Boom. Now you wait for this gap to be triggered, right? So as you can see, you get an SMT fill here. Look, it's going NQ. NQ trades into that gap, right? So if this is like a move higher or something, there's a CSD there, you're going to get stopped out. Now, since we have engaged with this 15-minute gap, there is no reason to return lower now. We've tagged every key level, right? So at this point, your lower time from entry is now protected. So now we're going to be covering alignments, aligning models within the models. This is how we get the highest accuracy within our trading, is when you even get in before we even take out these internal models, holding our trades into the overall external highs to the higher time frame. This is how we get excellent RR, how we improve our win rate, and overall, it's just a great framework to have. So let's get into it. So dropping down to lower time frame, let's talk about internal levels. This is very important. So every time we hit a internal level to the left, right, internal to the reversal, to the draw liquidity on the higher time frame universal model, every time we hit an internal level is we're going to get a new phase of price, ideally, you know, on the hourly and 30-minute, because that's what we trade, right? That's what forms the low of our 4-hour candles. If you're going to form the low of day, we know that key level must be the hourly and above. And typically we're trading the daily model, so those internal levels are going to be found on the hourly and 4-hour. But when we engage with these internal levels, we're going to get these new phases of price, right? And that's where the key levels on the right side of the curve are created, okay? So as you see, price expands away, right? We fall short of these highs, and then we start to retrace back in the range, right? Once price engages with these levels or expands, we get a new phase of price. Like I said, this is where we get our key levels to continue higher, right? So price retraces, engineers a low on the right side of the curve, and this is exactly what we're going to be trading, right? This is what we want to be used to go higher, to continue higher. This is like honestly like our last line of defense to go higher, right? Any move away from the draw liquidity, so this is a move away from the draw liquidity, is to be viewed as manipulation to get back on side with the overall direction in the market, right? And this is a really fractal concept, so you're going to see that exactly here. So you could say that this is a universal model, right? Where you have this manipulation of the low and manipulation of the high. You have a internal level here. And once you engage, like I said, you're going to get these new hourly and 30-minute swings. So now you have this model aligned, right? You're aligning key levels and draws and liquidity, right? Key level inside of our overall, you have like 3 universal models aligned here, right? You have the daily. Inside of that, you have this hourly. And inside the hourly, you have this hourly. You know, this is when you get really high probable confirmations to your overall draw liquidity and bias and whatnot, right? So as you can see, we failed to manipulate. This is perfect, man. This is what you want to be trading. But even inside of these little fractal universal models, inside of your models, you're going to have the same thing, man. So let's drop down to the 15-minute. You're going to see that we have a relevant level within this low, within this reversal point to this drawn liquidity. So as you guys can see, when price expands away towards your drawn liquidity, if you want to continue, right, or even after hitting a drawn liquidity, you're going to immediately look for the closest relevant low opposing to the drawn liquidity or the closest gap, right? And that key level is what's going to be used to continue through these drawn liquidities, or, you know, to be used to expand again, right? Those are also key levels you want to be using SMT with. So when we look at this, when price starts to retrace, it hasn't even reached this drawn liquidity, right? Which is actually a good thing. Now we have, again, a line draws liquidity. This is great. But we look inside of this range here from reversal to retracements, right? There's no key level to be used, right? What key levels do we only use? Highs and lows and gaps, right? We're keeping it simple, right? We're not using order blocks. But as you can see, there's no key level, so we must engineer it. When there is no key level, you must engineer it, meaning price will expand, retrace, and then create a swing low, right? That swing low is what you're gonna use for your key level, right? And as you can see, it is a relevant low in the market. The space between these lows is good. So this low is what you want to be using to expand again, right? As you can see, we kind of don't really manipulate it. We engage with it once, and again, like create two C2 candles, and you're gonna see the sequence that we cover in the advanced section, which is the last section. You'll be learning this last, but you can come back to this example. I'm gonna show you real quick. This is the SMT break triad sequence, where this asset kind of trades through a low, the middle assets over here. Right when it breaks it, price reverses, and in Q, that leading asset creates SMT with it, right? Very high probable sequence. So it might not make sense now, but it will later. You will come back to that. So we have an SMT with our relevant low, and this is what you can use to get back on side with the market, right? This is aligning models inside of models, very, very high probability. So now let's go over another example, right? Here we talked about price being inside of that daily universal model, and inside of that higher type universal model, you know, as price expands away, a lot of time has passed, we're going to create these higher time frame gaps. So this universal model, we're going to be aligning with our overall drawn liquidity. So once that is engaged, you're going to have internal to external. So now let's drop into lower time frame and see the same thing repeat. So here we are on the 15-minute time frame, and as you can see, this is our universal model, internal to external. We have those internal levels. This is an internal relevant swing here. When engaged, right, we get the new phase of price. Look at that consolidation. Now, in this case, I would want a higher time frame gap to form. As you can see, from draw on liquidity to reversal, we are hitting that internal level. We're also in premium, so naturally, I'm going to wait for a hourly or 30-minute gap personally. But early on that reversal, you're going to get these universal models to be aligned, right? And that's what we have right here. We have this 15-minute gap. This actually gets tagged here on NQ. So this is a great example of aligning models, right? So as you can see, this asset does not trade into that gap. But if we go over here on NQ, we do indeed trade into the gap, which is a continuation PSP, right? Price reverses, expands away, hasn't hit the drawn liquidity yet, prints a PSP. We want SMT between candle 1 and candle 2. That is a continuation PSP, and your confirmation to continue higher, aligning multiple models in the same direction.